Good afternoon, Quasar Markets Live. Hope everybody's having a great day. I am joined, as I am weekly, by Dr. Ellman, the president and founder of the Blue Collar Investor Corp. Dr. Ellman, how are you doing today?
Doing great. It's the highlight of my day to be speaking with you, Howard, on Quasar Market Live.
I love it. I love it. We do want to point out to everybody there's a lot of red in the market today. It is, coming off of the heels of the Trump tariffs. We've been talking about it, Dr. Ellman and I about it. Hopefully some sanity will come to the markets here. We'll get this to end. But we do want to point out we are in a very volatile time. These are some of the techniques and strategies that will help you manage these times. So make sure you pay attention to these videos we're putting out. Dr. Ellman, go right ahead. Let's lead us right in.
Well, the topic that you asked me about was an article I had published about a year or two ago, and it was on why at-the-money calls are frequently priced higher than at-the-money puts. Because intuitively, if a stock is trading, let's say at 100, and the at-the-money 100 call giving you the right to buy the stock at 100 should be priced the same intuitively as the $100 put, which gives you the right to sell at 100. So it just makes good sense that the at-the-money calls and puts should be priced exactly the same. But
yeah, I always thought they were until I started to look at some things and starting to experiment a little bit and put together some more sophisticated trades. And I found out the hard way that isn't the case. So I thought I'd come to one of our experts here at Quasar Markets, the contributors that brings us a lot of education on the option side. So let's talk a little bit more about it.
Yeah, well, generally speaking, and of course, there's always some exceptions, but generally speaking, at-the-money calls are priced higher than at-the-money puts. And this is related to something called cost of carry. So when you buy a call option, you have the right to purchase the stock at a certain price by a certain date. So instead of actually buying the shares, you are in fact controlling them, but you don't actually have to spend all that money to purchase the shares. So you're really saving, and you can keep that money that you would have used to purchase the shares into some kind of an interest-bearing account. And there lies the cost of carry. So the cost of carry relates to short-term interest rates, the amount of money you could make by not actually buying the shares, but rather controlling them by buying the call option. Now, if you purchase a put, which gives you the right to sell your shares at the strike price by the expiration date, you're not benefiting by that cost of carry argument as to why calls are priced higher than puts. So you're either giving yourself the right to sell shares you already own, or perhaps you're hedging your portfolio, but you don't have that benefit. So calls, which can act as a surrogate for the shares, but require lower capital up front. And that's why they have more extrinsic or time value than at-the-money puts.
That makes sense. I never really thought. I actually thought it might have to do with supply and demand, and that maybe people bought more calls than puts naturally because you tend to have more perma bears in the market, perma bulls, in the market than perma bears. So I thought maybe it had something to do with that. So I was way off on my view there.
Well, there are other factors that influence, but we're talking now specifically about at-the-money calls
Right.
versus at-the-money puts, which to most people, well, they should be exactly the same.
That's what I thought. And then I thought maybe, my first answer was, well, maybe supply and demand kicks in because as we know, that can be a weird player that people don't count that comes in. But I had never thought about the carrying costs or the money that you sort of lose in interest that somebody's looking to regain, so to speak.
Yeah, so we can move on to the next slide, Howard.
I did already. You're on.
Okay. All right. So we could actually do a little experiment. So I love doing these experiments. And in the article that I had published a year or two ago, I actually used an option calculator. And of course, I used Apple. I like to use securities that a lot of people are familiar with. And so we used Apple Computer, listed on the NASDAQ AAPL, as most of you know. And an options calculator will calculate the theoretical premium using a mathematical model. The one that most people are familiar with is the Black-Scholes model. There are others, but they use various algorithms to determine the value, or the theoretical, I should say, value of an option. And that's what I used in this experiment now to take a look at what the price of an at-the-money call and put would be, and moving it from 0% to 1% to 2%. And the hypothesis is that as you increase the interest rate, the difference between the value of the call and the put would increase in favor of the call option. Again, specifically, we're talking about at-the-money strikes. So when I did this little, when I published this article, I kind of had to wait for Apple to hit $185, so then I can go into an options calculator and do this, and it would actually make some sense. So there were two.
Actually, it's true. You have to wait for it to hit the round number for it to be able to have it.
If it's 185.46, this won't work. 185.46 strike. So yeah, I had to wait around, and then when it hit, then I went ahead and published the article. But there's two other factors here that I want to point out, because some of your viewers may say, "Hey, what about if?" And then this wouldn't apply. So what about if there's a dividend? Now, and specifically an ex-dividend date, because on an ex-dividend date, and maybe some of your viewers don't know this, but the ex-dividend date is the date that you must own the shares in order to capture the dividend.
Right.
And then the dividend distribution is sometime after that, typically week or 2 or 3 after that. But on the ex-dividend date, let's say the dividend is 50 cents. On that date, the share price will drop by the dividend amount, 50 cents. Now, of course, there are other factors that will impact the price of that security on the ex-dividend date, but one of them is minus 50 cents.
Right.
So that will change the value of that call option. And that's why I'm saying we have to assume now, with this little experiment I'm doing here, that there's no ex-dividend date in the particular contract that we're going to look at.
Right. Absolutely.
Also, if a stock is very difficult to borrow for people that want to short securities, again, this is an oddball kind of thing, but I just want to be thorough here. If it's a hard to borrow security, then put options become more valuable. All right.
Right.
People use that as a surrogate for shorting a stock. So those are the two that I'm saying we're making the assumptions of no ex-dividend date, and it's not a stock, certainly Apple isn't, that's hard to borrow. So, one would make calls less valuable, and the other would make puts more valuable.
Sure. That's where my supply and demand, I guess, comes in a little bit there, would be in those weird occasions where you have something like we saw with GME back in the day, where there was none available to short. We've seen that with MicroStrategy recently. And we look for those because that's where your short squeezes can come in, right?
Exactly. So a lot of people have heard of the option Greeks. So the option Greeks are factors that will determine the pricing and the risk of our options trades. And rho is the one that relates to interest rates. So the definition of rho is the sensitivity of an option price to a 1% change in risk-free interest rate. So a lot of us see change in interest rates, usually 25 basis points, sometimes 50 basis points. It's rarely 100 basis points. Right. But so rho, therefore, is not considered a major Greek, but it does apply in this particular situation to this particular topic. So call options, as we talked about before, have positive rho because they benefit. You don't have to buy the stock. You buy the option, so the interest rate goes up. There's more benefit to owning calls than puts for at-the-money strikes. And put options, in the same vein, have negative rhos. But again, it's not a major Greek. And just to be thorough with this discussion, Howard, I listed the other option Greeks. So delta relates to the change in the price of an option for every $1 change in the underlying security. There's also another definition of delta that is important if you're trading options, and that's the percent probability that an option will expire in the money or with intrinsic value. So, for example, if you're portfolio overwriting and you're writing covered calls on shares that you've owned for like a long time, maybe at a low cost basis, and you don't want that option exercise. You don't want your shares sold. Maybe you'll have some negative capital gains issues. Well, then you're going to select the delta, a very low delta, having a low probability of expiring in the money and therefore subject to exercise. Of course, you can always buy back the option, but this is one of the reasons why delta is important for the change in the price based on the underlying security and also probability of expiring with intrinsic value.
Absolutely.
Now, gamma, if we just go back to that last slide.
Sorry about that.
View the others. Gamma is just the second generation delta. So it's the amount that delta will change for every $1 change in the underlying security. Theta is time value erosion. So how much an option will decline in value for every passing of one calendar day.
Yeah.
And Vega, which I actually can't see on my slide here, maybe
It's
viewer
there.
can.
Yeah. Let's pull this away. We'll get it in there.
Yeah, there you go. Vega has to do with the change in the option pricing for every 1% change in the implied volatility of that underlying security. So if an underlying is more volatile, the premiums will be much greater, but of course the risk to the downside will also be much greater. So those are the other four Greeks in addition to rho. I would highlight delta, theta, and vega as the ones most important. And you don't actually have to look up these stats. I mean, sometimes you do when you're looking to get a trading range or that kind of thing. But you do have to understand the impact of these factors on our option trades to become really proficient at trading options.
Absolutely. It is one of those things. We will go over more in detail some of the Greeks on one of these sessions with you. They are so important. It does, it influences, and not many traders, especially early retail traders, understand how these all come into effect. I've had so many questions when a stock's gone up a little bit overnight and they say, well, why hasn't my option gone up? Because theta was involved. And especially the closer we get to expiration, where that is an exponential number, how that moves towards the end of expiration is very important. So I will hit you up for that over the next few weeks here to talk a little bit more about. And I think it is so important for our viewers to understand that. It's one of the reasons we also talk about, and you're one of the educators that stresses this here on Quasar Markets, paper trade till you know what you are doing, right?
Yeah, I mean, nobody's perfect, and I don't think there's nobody that I know that knows everything about any one particular strategy, and that includes me. But if you always should leave the door open that there's always room for learning and getting better at something. And at the beginning, a lot of people, when I do my seminars, whether they're live or online, they get very excited about these strategies because it starts to make sense to them. At least hopefully when I'm explaining it, it starts to make sense and they get very excited and they want to start doing these strategies like the next day. And so I said, wait a minute, put your brakes on. I'm giving you some, hopefully you feel good information, but you need to actually integrate this. You must educate yourself. You must practice a little bit, like you said, paper trading, and then dip your toes in the water. Start slowly, start with smaller amounts of money. And then as you gain more confidence, you get better and better at it. Then you could start adding more cash to your portfolios. You're going to be seeing your portfolios growing anyway if you're doing this properly. And then you could start doing more and more trades until you find the sweet spot that's right for you. Because no matter how good you get at it, there's always going to be a certain number of trades, of contracts that you're comfortable trading, not necessarily for the cash reasons, but also for how much time and effort you're willing to put into it, monitor your trades, so on and so forth. And that will vary from investor to investor. For me, I do about 100 to 150 contracts a month, which represents 25 to 35 different positions. That's my sweet spot. But when I
Right.
started out, I was doing like 5. That was
Yeah,
it.
and I'll even point out, you and I were talking earlier, you've been helping me on a strategy that I'm looking at doing for Bitcoin's ETF, the IBIT. And I haven't even started it yet because I've just been paper trading and watching and seeing these reactions. First reaction now today to a black swan event, so to speak, over the weekend. I can now analyze that because I, who have many years of experience trading in options, even want to take the time to learn it. I don't want to just throw money. I'm going to be putting, $10, $20, $30,000 into a position that I'm going to be looking at. I want to make sure that I have all of the kinks sort of worked out, that I know what I'm looking at, that I'm entering the right numbers, that I'm understanding what influences will affect the trade and how they affect it and what my result of that will be and how I will react, right?
That could be a good topic for a future discussion, Howard, because IBIT has very good, robust implied volatility, as you know, and
Yep.
so you have some pretty good flexibility with the type of options you're going to be leveraging with that security. So you don't necessarily even have to buy it. You could start out by selling an out of the money put. But this could be a really interesting topic for for using a security like that has a nice, robust implied volatility, and how you could do it from first a defensive perspective and then work your way up to more aggressive trades.
Awesome. I love it. I'll definitely be taking advantage of you for that. And we'll take a look at that. I think would bring some great added insights to our viewers. Yeah, I brought it up today and it sort of played out too, is what to me, Bitcoin has now become basically, because Bitcoin shouldn't be down today at all. It has nothing to do with tariffs. It doesn't care about tariffs. Maybe the fact that the DXY and the dollar jumped up would give you a little bit of concern, as a reason to why there would be risk off. But what it's really become is almost a 2.5 to 3x volatility move on the QQQs is what I've noticed. And it played out. We went down 9, they went down about 3, and then they moved from there. So that's sort of how I'm looking at it.
Okay, well, when it comes to Bitcoin, you're the pro with that. I'll be your student.
Yeah. Okay. Well, let's take a look at these Apple calls.
Okay, so as we said, we expect the at the money calls and puts to be priced the same, and they generally or theoretically will be if there's if there's a 0% interest rate. So I caught Apple when it was trading at exactly 185. And the other factor that you have to put down into the calculator is the starting date of the trade and the expiration date of the contract. So you could see on the top left the start date 1/8/24, expiration 2/9/24, so about a month out, a little more than a month out. So that's just, you get that from an option chain.
Yep.
And then you have to put in the price of the stock and the strike price. So those are the same because it's an at the money, 185. And then you have to look up the at the money implied volatility. And that you can get for almost any option chain. So the implied volatility of that particular at the money strike was 23%. So you have to put that, where the blue arrow is, into the calculator. And lo and behold, you'll see where the red arrow, the horizontal red arrow is. It came out to where the theoretical value of that 185 call, once again, let me highlight that this is a 0% interest rate scenario. You could see the red arrow, the small red arrow on the right rather, 0% interest. And that came out to $5.137. And that was for the call option. Now, in the next slide, we did the same thing with the put option. And you could see the red arrow on the top points to the put. Same 0% interest rate and same 23% implied volatility. And lo and behold, the theoretical value of the put is exactly the same, $5.13.7. So that makes sense because we're talking about no cost of carry, 0% interest rate. So now again, we're talking about short-term interest rates.
And I
Now, what?
will point out that, we went through a few years where this was pretty much the case, right? Or close
Yeah,
to it. I don't think we're ever returning to a place like that. We've talked about it a lot with our educators here. The four area for an interest rate gives the Fed a lot more room to lever up and down from that level. When they were at zero, there's no room to the downside to use a lever, right? So I don't
how about
think
in
we'll
Europe
ever.
where you had negative interest rates? You had to pay them
Yeah.
to put money in the bank.
Oh yeah, Japan, they have done it until recently.
Yeah. So now let's take the same example in this little experiment of ours, and we're going to go to a 1% interest rate. This was a little bit later on in the day, and we could see here that uh, Apple's 185 call towards the top was greater now than the 185 put,
Yeah.
5.095 to 4.942. So now the cost of carry factor is beginning to influence the at the money strike price. And what if we brought it up to 2%? Well, we would expect that difference then to be a little bit greater than what you're seeing now between the 5.09 and the 4.94. So
Right.
I went ahead and did that. Once again, same 23% implied volatility, but now the interest rate is 2%. And you could see here again that the difference between the at the money call and put is greater with the 2% moving from 1%, 5.175 to 4.872. So this proves the impact of cost of carry and explains why at the money calls and puts are not priced precisely the same, and
Right.
that you give the advantage to calls because of the cost of carry factor and the benefit of taking the money that you would have used to buy the shares and keeping them in an interest-bearing account and reflecting the short-term interest rates.
So I have a question that I don't know if it makes sense or not. Does the interest rate usually follow the Fed's rate, the 10-year, the 30-year, or does it go by the individual stocks where they would each have their own based upon sort of what their Moody credit rating is, what their borrowing costs are?
No, it's the short-term, it's the general short-term interest rates, like for the treasuries. Uh,
Okay.
yeah, it's not, it doesn't vary from stock to stock.
Okay. I just wasn't sure, if it was
That's
if
the
it was
interest rate
the
that
same
you
or if it took into
enter.
account,
Yeah, you
'cause
the short-term interest rates that applies across the board, not stock by stock.
okay, that makes all the sense in the world once you say it, but I just wanted to check.
Yeah, because you think about it, Howard, if you're not taking the cash and buying, 1,000 shares of Apple at 185, but you're buying like 1,000 calls at $5, you could take that money and put it in an interest-bearing account, and that
Absolutely. A money
interest-bearing
market, a
account,
CD, your bank account at
yeah,
4%, like some of them are offering right now,
yeah.
that would be what you'd be looking at as that rate, so to speak.
Right. That's the fact, the cost of carry factor, and it's the same for every security that you're going to calculate.
Right. That I think that's important takeaway. It isn't, in fact, based upon volatility. It isn't based upon the individual stocks. It's actually if you took your dollars and you were putting them in your bank account, so to speak, the interest rate return that the market would receive for that is what it's using as that number.
Yeah. When you said volatility, that of course will affect volatility, as we said with Vega, will
Right.
affect the option premium if the implied volatility of the underlying security changes. So just one very, very common example of that is that if there's an upcoming earnings report, well, the volatility of that security typically will be much higher than after the earnings report or between earnings reports. And so a lot of people get enticed by these option premiums prior to an earnings report and will tend to select that contract because instead of getting, let's say, 2.5% for a month, they're getting like maybe 4%. But what
Right.
they're forgetting about is that the earnings report can disappoint and you can go down 20% if
Right.
it
The risk
doesn't meet
factor.
consensus. So that's why I always say you have to avoid earnings reports across the board under all circumstances, and that relates to the implied volatility or change in vega that occurs prior to an earnings report. And then, of course, right afterwards, the volatility goes way down right after the earnings report.
Absolutely. Absolutely. You've brought those up. I will point out to our viewers, please look at the series that we have on YouTube. I'll be updating that. I noticed the new software I use doesn't put them all together, so I have to go back and get a couple of them added to the folder. But Dr. Ellman comes in every week. Where this is, I believe, our 14th interview, and we keep them all up there so that you can learn from them. And we have ones that go over that exact avoiding earnings costs, especially with this covered call strategy, without a doubt.
I think it's 15, Howard.
Is it 15?
I think so. I might be wrong, but
you're probably right. You are probably right.
Anyway, to summarize, Howard, we went through this a couple times already. Rho is a minor Greek, but it is a factor nonetheless. And the reason why at the money calls and puts are priced differently, with calls having the advantage, has to do with the cost of carry or the interest you can garner by taking the cash that you would have used to buy the shares and putting it in and getting a short-term interest rate. Now, the two exceptions I alluded to earlier, just to make sure everybody remembers this, can relate to ex-dividend dates, which decreases the value of a call, or if there are certain securities that are very hard to borrow, you can't short, then that increases the value of the corresponding puts.
Absolutely. Well, I want to thank you so much, because I didn't know why there was this difference, and have been trying to figure it out. What I'm trying to bring is your insights to our newer viewers, our newer investors, because it can be such a big learning curve when it comes to options. And again, what I want to recommend to everybody is that you're taking the time to learn, you're taking the time to practice before you enter these trades. Again, I had someone reach out to me over the weekend that had bought some calls, and now they're in trouble because they're not going to bounce back most likely by the end of this week when they expire. And they were wondering what, mitigation they could make now. And if you're not knowing these things going in and having stop losses and take profits in place, you set yourself up to lose quickly.
Good advice, Howard.
Okay, well, thank you so much, Dr. Ellman. Like always, we will have you back next week. And again, are you buying this dip? I forgot to ask. Are you buying the dip today at all, or are you waiting this out a little bit?
I'm probably going to sell some of my positions. Anything that was called away, because several of my options expired in the money, and those shares got called away. So I'm going to leave that cash on the sideline for a while, and I might sell some of my positions that have appreciated substantially. I'm going to cut back a little bit, but when I am going to do a lot of trading after we get off this call, and I'm going to be taking mostly defensive postures with my trades, which means in the money calls, deeper out of the money puts, and depending on how things go with these tariffs and depletion of the workforce kind of concerns, there are securities that go up when the market goes down. You can go
Absolutely.
to some inverse ETFs also. I mean, I don't think I'm ready for that yet, but that's another bullet in our arsenal that we may look to if things get of greater concern. They're not there yet, in my humble opinion, but yeah. So I am going to cut back on the amount of cash in my portfolios a little bit, and I'm going to take defensive positions with the ones I'm about to go into over the next 2 hours of trading.
That's awesome advice to give the markets. I'm hearing it from most of our educators in the same way. One thing we talk about, it's about preservation of capital when it comes to, investing being just as important as, other aspects of it. And these are the times where you have to start to take a look at your positions. And one of the things that it's hard for retail traders to do sometimes, and it doesn't seem to be hard for the professionals, is to cut bait. If something's down significantly, you look at your money and say, is it best off to recover within the same stock that I'm in already? Or am I better off pulling that off and looking for a better position where maybe I could, recover some of that lost income quicker?
How many people were murmuring that Bear Stearns has got to come back?
Yeah, no, that's exactly it. No one likes to hear that, and no one likes to take losses. But it's one of the things we try to explain to traders here at Quasar is you just have to. Don't put yourself in a worse situation. Don't go down with the ship. You aren't the captain.
Well said.
Okay, well, we will see you again next week. Thank you so much again, Dr. Ellman.
Always my pleasure.